The Federal Reserve met today, and guess what? They actually paused their interest rate hikes for once. So the federal funds rate sits between 5.25 and 5% right now. And we're going to talk about what that means for you. But basically, they're trying to keep their interest rates this high because they still haven't reached their target inflation. Now, on the news, the NASDAQ actually was down 1.5% today. It was actually trading relatively flat during the meeting. But then after the meeting, it just absolutely took a crap. Now, if we all want to see how the year has been going, the S&P 500 is actually up 15% year to date, despite all of these interest rate hikes. We're going to talk about why that is later in this video. But for now, all you need to know is that they're raising interest rates, and they're doing so because inflation is at 3.7%, and that's way above their 2% target inflation rate. Now, in terms of the categories that have been increasing year over year for inflation, we're seeing this is the chart from 2023 August. We're seeing food at employee sites and schools up 57.6%. We're seeing salad dressing up 12.1%, frozen vegetables, motor vehicle insurance, so car insurance is up, rent of primary residence. You can pause the video if you want to see the full breakdown right here. But a big reason why it's been going higher lately are because of gas prices. So they're actually up 10.6% in July. Now, I don't know about you guys, but where I am in San Francisco, it is $5.50 per gallon just to buy a tank of gas right now. I think it's a lot higher in many different parts of the country. Let me know how much your gas is, but we can see right here that the average price per gallon is around $3.87, according to this article from Barron's, and that's pretty high. So let's actually cover what happened in the meeting today, but to do that, we should understand how many times the Fed has actually met already and raised interest rates. You can see this is a full list of all of their FOMC meetings and how much they raised interest rates by. I think of the last 13 times they met, they've raised interest rates 11 times. I don't know if I'm 100% right on that, but today they had no change, which was a pretty good sign. Now, one of the most interesting parts of today's meeting was from a moment where a journalist asked Jerome Powell if he thought a soft landing was his baseline expectation, which led to this tweet. But let's actually watch it right here, and let's actually just listen to how the journalist phrases this question, because I think it's really genius.
To boil that down for a second, we've gone from a very narrow path to a soft landing to something different. Would you call the soft landing now a baseline expectation?
No.
So basically, the journalist was trying to get him to admit that we were on our way to a soft landing. Now, had he said yes, I'm sure the market would have just rocketed up like a rocket ship. Now, because he's mostly very pessimistic, and he needs to stay pessimistic, but also yet remain a little bit optimistic. I know that kind of sounds like a paradox, but if he were to signal that, yes, we were on the path to a soft landing, and he were in fact incorrect, then the markets would be even crazier. So on the back end of the meeting, they basically said, we're not going to hike interest rates, but we are going to keep interest rates pretty high for a while, at least until 2024, the end of 2024, maybe early 2025. Now, the S&P 500 today reacted also quite poorly. It's down 0.94% or close to 1%. And right now, the markets and the traders are targeting around a 71% chance that the interest rate will remain the same in November, and a 28.4% chance that the interest rates go up by 0.25%. Now, you're probably wondering to yourself, why do interest rates need to go up? What are the economic impacts of interest rates as well? Well, first of all, borrowing costs will rise for businesses when interest rates are higher. So we're going to talk about how that impacts the stock market. Borrowing costs rise for consumers. As you may or may not know, it's really expensive to get a loan right now. As well as you can also get some higher yield in your savings accounts because of the interest rates being high. So those are some of the things that are going to be affected by interest rates, and that's pretty interesting to know. Now, home prices, as we may or may not know, they are quite high. And they're quite high because not only of interest rates, but because of low supply. So median home prices as of late are right now, they are at $416,100, and that's way above the pre-pandemic levels that it used to be at, around the 300,000 levels. And part of the reason why is the low supply, but let's actually talk about mortgage rates first. So when it comes to mortgage rates, with a high credit score, you're still getting a 7.5% mortgage rate. That is way higher than the year before. If we actually look here at a $400,000 loan, at a 7.5% interest rate, the monthly payment is close to $2,800, But at a 4% interest rate, the monthly payment is $1,900. That's $800 less for the same loan, just 1 year apart because of the interest rates. Now, one of the reasons why home prices are also expensive is because there's just not that many of them being constructed these days. Housing starts have fallen to their lowest since 2020. That means new homes aren't being constructed. People that have existing homes don't want to sell their homes because they're probably locked into low mortgage rates. So we can actually see this right here. Just 1% of the nation's homes have changed hands this year, the lowest share in at least a decade. And this kind of makes sense, right? Like if you bought a home from 2010 to 2020, and maybe you locked in a 2 or a 3 or a 4% interest rate on your 30-year mortgage, there's no reason for you to sell right now just to lock yourself into a much higher mortgage rate. So you're just going to hold on to your house. And that's why supply has been lower, rates are higher, and this compounding effect is making home prices quite unaffordable. So if we actually look, SoFi did this study right here of the price to rent ratio by city. It basically just shows you that right now it's so much better to rent in so many of these cities compared to actually buying. So if we actually look right here, the ratios are right here. A ratio of 1 to 15 typically indicates that it's more favorable to buy than to rent in a given community. Remember this number, 1 to 15. If we actually look at all of these numbers, higher is worse, by the way. San Francisco has a price to rent ratio of nearly 38. That means it's much better to rent than to buy. And in fact, all of these cities right here, San Diego, New York, Boston, Portland, they're all above 20, 25, whatever. And it's not until we get to Tulsa, Oklahoma that has a price to rent ratio of 19, which is anything less than 20. So it just really goes to show you right now, it's really hard to buy a house. How do interest rate affect stock though? Because the stock market is something that's kind of an anomaly. Like we're seeing the stock market continue to rise, yet interest rates have risen as well. And the thing is that when interest rates are high, theoretically, when interest rates are high, companies are going to have a harder time borrowing. So a lot of the growth companies that you're going to see out there, their growth is going to be stifled because they can't borrow at a low interest rate anymore. But let's actually look at the historical happenings of what happens when interest rates are high and the markets. So I found this chart right here. This chart shows the various interest rates and the S&P 500's corresponding returns back to 1970. If you remember, in the late 70s and the early 80s, the interest rates were extremely high. They were close to 18 or 20% in order to curb inflation at that time. And you can kind of see this here. The Fed funds rate, the starting rate was 5.5% from 1976, and it ended closer to 20%. Yet the S&P 500 still returned 68%. And in fact, if we looked all the way down the list here, the S&P 500 typically returns positive. So there really is no correlation between interest rates and the market. You would think it does, it should have that, but historically it looks like it just performs pretty good. Now, there are some implications of higher interest rates on the crappier companies out there. A lot of companies are defaulting on their debt, but a lot of these companies are quite small. I think she even says right here, obviously we have some notable company defaults like Bed Bath & Beyond and Silicon Valley Bank and Silicon Valley Bank Group and AMC, a lot of these. But a lot of these companies that are actually facing distress right now are these smaller companies. The NASDAQ this year is still up 30% year to date, despite the higher interest rates. And so what's really happening here is kind of a paradox. And one of my researchers and writers, his name is Tim Chang. He has his own newsletter called Quantitative Edge. He actually wrote about this today. Basically, he's saying that high quality borrowers weren't affected by the interest rates as they had secured low interest rates during the pandemic with bonds set to mature further in the future than any other time this century. Basically, what he's saying is that a lot of these nice, bigger companies, let's say Microsoft, they locked in a really good interest rate on their loans. And so because of that, they're not in such a bad financial position that their stocks are going to suffer. In fact, Microsoft actually made money on the interest difference. You can see that their interest expense was around $492 million in the last quarter, but they actually made $905 million on their cash. So this is a really good newsletter. I'll link it down below in addition to our newsletter. But because interest rates are going higher as well, the 10-year treasury, oh my God, I have the pinwheel of death. Because interest rates are higher, the 10-year treasury is at 4.39%, which is a yearly high. And so what you're seeing a lot right now is because treasury yields are so high, you're seeing a lot of people move out of stocks into bonds or out of stocks and into high yield savings accounts, which are paying around like 4 to 4.5%. you can see that evidenced by this headline: higher treasury yields in more than 15 years drag stocks lower. And higher interest rates, inflation push Gen Z investors to trade stocks on emotion. That may be bad, experts say. I would agree that's very bad. If you watch my channel, you will know that the best thing to do is to always dollar cost average and hold for the long term. And we're going to talk about why that is in just a second here after we talk about the economy. So what's really interesting here is that Vanguard has actually said that they think there's a recession going to happen next year. And so the chief global economist for Vanguard, his name is Joseph Davis, has dropped a forecast saying that because of the stubborn inflation, we're seeing a base case for a recession next year with a 70% probability in the next 18 months. Do I believe him? I don't know. They've been saying that there's going to be a recession for the past 12 months or 18 months. You've seen all the YouTube headlines. It hasn't happened yet. In fact, what we're seeing right now is actually pretty interesting. GDP is up every single quarter for the last year or so. So, I mean, this was our technical recession. It hasn't happened yet. I don't know if it's going to happen. The best thing you can do as an investor is to just continue to buy and to hold for the long term, especially if you're a long-term investor. This is one of my favorite studies of all time. It's by Charles Schwab, and basically they gave 5 hypothetical investors $2,000 each every single year for 20 straight years, and they had 5 different investing styles. So this goes to show you the power of long-term investing. I'm going to show you, this is the graph right here of the actual results. So spoiler alert, the results are right here. But Rosie is the person with the worst timing imaginable. She invested at the very peak of every single year, versus Matthew and Ashley, they had lump sum or dollar cost averaging strategies, and Peter was perfect. He had perfect timing. But I want to show you the difference here between Rosie and Larry. Larry left his investments in cash. And because he left his investments in cash, his $40,000 total contribution only grew to $43,948 at the end of 20 years. Versus Rosie, even though she had the worst market timing possible, she still made out pretty decently. And this is a study that I'm going to talk about in my YouTube video tomorrow that's coming out. It's called The Ultimate Investment. It's about index fund investing. I hope that you guys check it out. And lastly, I hope you guys check out my newsletter. It's called Hump Days. We come out with free business and finance news twice per week. And lastly, let me know what you guys think of this new format. This is just a news format that I really liked from a streamer called Ludwig, and he's one of my big inspirations, so I credit this to him. If you like this format, let me know down below. Make sure to subscribe, and I'll see you guys in the next video. All right, bye now. Peace.